welcome to our first lecture. In this lecture, we will have a look on what is it meant by a conceptual framework for financial reporting. Basically, framework is some regulatory or institutional framework which forms the overall base for the financial reporting standard setting process. And it represents a set of generally accepted principles in order to design new accounting standards and implement existing ones. Now, the development, implementation of the financial reporting standards are on due by IFRS Foundation. This is a non-for-profit organization, international organization, which is responsible for developing a single one set of high-quality global accounting standards. And these standards we are calling IFRS Standards. Now, what should be considered within the legal environment? Let's have a look. Main elements which impact companies' accounting and financial reporting processes are national laws, which might vary from country to country, European Union or other regulations, which also will depend on where company operates, securities and exchange rules, tax regulations, and accounting principles. Now, the key goal of IFRS regulatory framework is to ensure that the users of financial statements receive information which is good enough or which is of high quality to enable them to make effective economic decisions, which means that our financial reports, financial statements should be oriented on the external users that make economic decisions. Now, can you think about benefits and barriers for accounting regulations? Can we think about the next? What if financial information which comes from different countries lacks consistency? Or what if reading and interpreting the numbers in the financial statements and doing business overall makes us more and more confused and makes the process more and more complicated? Well, all these questions are answered by IFRS standards, meaning that we will consolidate the results coming from different parts, and this process becomes easier if all the countries follow the same rules. For investors, harmonization or moving to the standardized process will make it much more easier to compare various entities between each others and to make fully informed investment decisions. What we can say else here is that harmonization or using a single set of reporting standards makes it much easier to control tax statements, therefore limiting tax avoidance. Now, when we have considered all the benefits and we can say that that's obvious, let's think about barriers that make the full harmonization of accounting standards almost an impossible task. Basically, we will speak here about different social, political, economic contexts, differences in legal systems of different countries, cost which might increase in terms that company will need to make reorientation of its financial statements to the new standards. Now let me introduce to four main institutions which are at very heart of the IFRS standard setting process. The International Accounting Standards Board, or IASB, the IFRS Foundation, the IFRS Interpretation Committee, and IFRS Advisory Council. Let's have a look at the typical process, how the new standard, new International Financial Reporting Standard is developed. At step first, IASB identifies a topic. Then it appoints a committee from its members, discusses paper, draft report with the main stakeholders, then encourages comments from a wider audience. At this stage, IASB will publish an exposure draft. And at final step, following the receipt of the comments and after analysis of the received comments, the IASB will usually publish the final text of the new IFRS. We will now move to the next question and we'll discuss why conceptual framework is necessary and what an alternative system might be.